get going. Well, good afternoon and welcome. Thank you for taking the time to participate today. My focus will be a review of what occurred in financial markets in the first quarter of 2020. For those of you who don't know me or don't know me as well, founder and chief investment officer at Wealth Factor. I started Wealth Factor in 2017. I've been investing for over 20 years now. As I reflect back on that stretch, I really got involved for the first time in stocks during the building up of the tech bubble. My perspective is really filled with environments like what we saw in the first quarter from an investor perspective. I have a broad career or background in investments and investment management. I did trading and portfolio work for a local asset manager. I had the opportunity to create my own firm. I did that in 2007. It was called Bandon Capital Management. In the evolution of Bandon, launched a mutual fund. That mutual fund happened to be in an area at the time in the mutual fund industry that was attractive and fast growing, and that mutual fund business line got purchased by a public company named Fortress Investment Group. And after that acquisition, I went to work for Fortress and acted as a managing director there. I moved to the Lake Oswego area in 2012, largely because of schools and the life choice and priority to not travel has led me to the start of Wealth Factor. Wealth Factor is Lake Oswego based and focused. It's an investment advisor. What we do is create custom plan-based investment advice, and we deliver that through managing custom portfolios that are largely index-based on behalf of our clients. Our client accounts are custodied in each individual client's name, and those assets are held at a third-party custodian. And Wealth Factor generally operates as a fiduciary on behalf of its clients. Our fee structure is unique. We charge 35 basis points on assets up to 10 million and 10 basis points or 0.1% on assets over 10 million. So just a couple kind of contextual and positioning points relative to introducing Wealth Factor briefly before I get started in terms of my financial markets comments. The founding driver to Wealth Factor and what it is really the belief that the investment advice industry is largely outdated, unnecessarily expensive, and very inefficient. I believe that the robo-investment advice world, while from an investment deliverable perspective has merits, isn't a good fit for the high net worth and ultra high net worth investor. I believe that investment advice professionals need to take the technology and innovation that's being created and done by the robo-investment advice world and leverage that to provide a direct to consumer investment service like what I built at Wealth Factor. So I believe that this is critically important, and we are seeing the effects of a relationship between high fees and risk play out in the first quarter. So I believe there's absolutely a value to paying for investment advice. If you're a individual investor or any investor at all, emotions are very difficult to separate out as you make investment decisions. And so having somebody else do that for you, I think makes a lot of sense. And then to the extent that the way in which it's delivered is system oriented and devoid of emotion, I think it's that much better. And so this graph suggests that, I use this graph to illustrate a concept that I believe it to be true, which as fees on the bottom axis go out and increase, the initial set of fees is to an investor's benefit, the benefits of getting advice, independent advice. But then at some point, and probably pretty early on, those fees start to force increased and unnecessary risk taking, which will negate the benefits of those fees. wealth factor is designed around what's called risk smart investing, which has three different component parts, being portfolio smart. So the key elements there are avoiding the picking and timing whenever practical of investments. That's both on an individual investment basis as well as sector or even geography, to the extent that a geographically diverse portfolio is being used. And then in relationship to really fees, avoiding layers and complexity. And so I believe very much in implementing investment plans that are centered around a disciplined simplicity. The next part is fee smart, which is to some degree covered by the prior slide, but we charge 0.35% as previously mentioned. And then largely when building portfolios, we base things on indices, which allow for cheap and efficient implementation of diversified portfolios. And then lastly, and what's probably one of the most underappreciated area in the investment advice service community is tax. So in building portfolios, doing that really with a mind and eye towards the tax implications of those portfolios over time, I think is critically important. So now on to, well, first of all, as I transition into the content part, I'll start with a very long-term perspective and then start to drill down a little bit. So this graph here takes a minute to absorb, but what it is the stock market going back all the way to 1900. And what makes this graph unique is that it's in log format. So if a graph going back to that far weren't in log format, you would see a very slow, gradual line and then an enormous ramp up after that. And you really wouldn't get any information for anything before a certain point, 1960, 1980, something like that. But by putting it in log format, it visually creates similar, anything that's a similar percentage change, it makes it look visually similar. So this graph gives us kind of a long-term expectation of what's happened in equity markets over time, and is ultimately, I think, the basis for why people should invest in stocks. It's right now we're seeing a lot of investment professionals reevaluate and talk about the Great Depression. I don't think there's any reason not to look that far back and be cognizant and aware. I don't know that that analysis, anything that goes back that far from analysis perspective, is all that useful today. As I think about the dynamics of our economy today versus then, I mean, we're very much, or the whole world, global economy, and including the U.S., was very much at an emerging and developing stage. And really, the U.S. is in a far different and more mature and developed mode at this point. And so I don't know how useful those comparatives are. But as I look at this and say, okay, well, what sort of things can we glean from this? There are, it's one thing you can see is that there are prolonged periods of time where stocks are going up, and then periods of time where stocks aren't necessarily, or basically flat over long periods of time. So that's number one. And then number two is we can look at the shape of this period where stocks have been going up and compare that to prior periods and see that, one, most clearly, that the length of that time isn't anywhere near as long as the stretch in the, let's say, 50s through 1970, and then the 80 through 2000 stretch, not nearly as long. And then less obvious is the slope of that curve isn't as dramatic either. So, there's plenty of, I don't point any of this out to suggest there's predictive value in this. However, for those that want to make the case that, because we've seen equity markets go up so much and for so long, we're due for some very terrible period, or a period where we're not going to make money, I don't believe that you can make that case, and I think there's this historical evidence shows that. So again, not attempting to be predictive in either good or bad in trying to look at what are the prospective outcomes for equities over the long run. So Q1 2020, clearly we had some downside volatility. The S&P. So this graph here is displaying each calendar year going back to 1980, and the gray bar shows what the end annual return for the S&P 500 was, and then the red dots and the corresponding negative red numbers are the intra-year low points. And so, I use this to say that, show that what we've experienced so far this year isn't uncommon, and provide some context and perspective to its magnitude. We can see that it's not super common in the magnitude of being down 34 at the low point during the quarter. But in many environments, even in that same year, you see dramatic differences between where the market finished and where the market that low point, with 1987 being one that's significant positive outlier, down -34, finished the year up 2. In most cases, we're seeing really those low points as excellent opportunities to invest that really don't come up very often. The only caveat or exception really to those that low intra-year period is 2002 or 2001, the first down 30. Investing at that low point, you're gonna feel an even lower point in 2002, I guess, relative to that. But for money that had gone to work at that down 30 point, that's going to be short-lived pain, really, and that's the worst of all of that. So again, all of this isn't necessarily intended to try to figure out something that's predictive, just simply to put a context around our current experience. The natural question that comes to mind is there something different about this time? And the practical answer to that is yes, absolutely. There's always something different in every time, but does that make it different from how we should treat it as an investor? That's where I start to tilt pretty heavily to probably not. And so what this is an analysis at the beginning of each decade, going back to 1970, reasons not to invest, or what was going on there. And we're just constantly in environments where there are geopolitical or other sorts of things that are scary and give us, if we're going to invest based on how we feel, reasons not to. And so this 2020, we're starting out with originally it was just election year uncertainty, and some tensions in the Middle East, and now the coronavirus is in the corresponding mass shutdown of economic activity is the reason not to invest this year. And so this I think it's just important to remove yourself from what the fear element of the day is. I believe that while we could go through a very unpleasant period of future economic activity, there is incredible inherent value in our infrastructure and the aggregate activity of not just the U.S. public companies and the goods and services that they produce, but those on a global basis. And to the extent, so markets reprice really quickly, and they've done that maybe at record pace in the first part of this year. I think that's more driven just based on the speed of information and the speed of the types of participants and their ability to make quicker decisions, more so than a true reflection of this environment being worse. Regardless, though, I believe that these investors should be looking at the peak points of fear and major declines to the extent they can as opportunities to either increase risk or just get invested. at these lower prices. As I think about it, whether it's a 1 quarter hit to U.S. productivity or it's an 18-month hit to U.S. productivity, if you think about it from an investment perspective, you're an investor who wants to own in aggregate or in some sort of slice a diversified exposure to the U.S. or global set of public companies that produce goods and services. You really shouldn't be all that worried about a slowdown in the short run. What you're worried about is, are those companies going to provide and produce those goods and services over the course of the next 10, 15, 20 years? And are they going to be able to not just exist, but grow earnings? And I think that the highly likely answer to that is almost for sure. And then, if you believe that, then and you want to be an investor, the best time to be investing is during the periods where the prices are the lowest over that entire period. And so, but I think the natural tendency is to say, I'm not really comfortable. There's reasons not to invest. I'm going to wait until it does feel comfortable. And out of all the things that I believe, from a conviction magnitude perspective, I believe that once you have that comfort, it will likely be too late. I don't know that we're anywhere near that level, that point, but I don't think that matters. But I think that we'll see once there's an all clear feeling, prices will have already moved pretty dramatically, just like they have been moving to the downside so far during this period. So I put together this analysis. May take more than just a quick overview, but just wanted to share a concept here. I went back all the way to 1927 with the S&P 500. I took each day's performance, and based on that, created first rolling 12-month periods in the performance, and then I isolated rolling 12-month periods that were down both 25% and 35%. So there wasn't any special, or it was fairly random in selecting those two. And part of the reason for this exercise is we just, as that prior graph showed, aren't that many data points where we have these sorts of extreme declines, and so a rolling period analysis increases the number of data points. And so there's issues with doing that in the data, in that they tend to clump all around similar periods. And that's why I've sliced this into 3 different categories to help deal with that. But then I took those periods and then I looked at the percent return over the next 5 years and the next 10 years. And so the first gray column here is 1927 to current. And then in my initial analysis, I did 1960 to 1979, 1980 to 1999, and 2000 to current. And in doing that, I identified that all 3 of them initially I did 1980 to current and then broke that out. And I identified that there weren't unique periods in those different time periods. And so I then broke it out to try to identify different instances or occurrences, and that's how I got to the 1960 to 1979, 1980 to current. The takeaway here is that over the following 5 years of all of these occurrences, and so in aggregate, from 1960 to current, there were 200 or just under 200, and in all the following 5-year rolling periods, the worst returns were all profitable. Same thing for the 10-year exercise. And so, is this predictive? No, but it is supportive of the idea that the lower you buy something, the less risk there really is. So, kind of continuing to build on the point that, if we're going to be worried about what might happen tomorrow in the economy and waiting to get comfortable with putting the money to work or being invested, we're likely going to miss what are, fairly rare opportunities to buy at prices that are low. So another thing that I've been tilting towards as I think about things, so there valuations matter, but valuations are more complex than we might think, because in order to value something, you have an uncertain element. What will the future earnings of something be? And so there's a natural challenge with trying to predict what value is, because you have to predict what earnings are going to be in the future. I mean, you can look backwards, but what we see really quickly in an environment like this is there is a ton of uncertainty with going forward for earnings. And so the uh, as I think about putting money to, this concept of investing at lower prices, taking that a step further and breaking down companies based on factors, and the simplest one are value oriented companies, which would be a company that trades at a price that's attractive relative to its expected or historical earnings, versus a growth company that trades really based on its future prospects for earnings growth or revenue growth. And so this graph on the left is the first time I've seen something like this, but I think it's really useful and really valuable, because there are a lot of asset managers who built their business around the long run in factor bias, that value will outperform growth over time and small will outperform large. Well, I hear constantly from people that were exposed to those sorts of asset managers over the last decade that just didn't work. Well, it's my belief that this graph speaks to that to some degree. So if we look back and so what this is saying is that during periods above the middle zero line, growth is cheap and value is expensive. And so buying, if we say, okay, from a price perspective today, prices are generally lower, I'd rather generally be buying today, taking the next step and saying, of what types of companies would I like to be buying specifically in this sort of environment, and which ones are cheap relative to other companies. This graph supports today that value is starting to look cheap relative to growth. And as if you're going to look backwards and say, well, value didn't do very well over the last 10 years. Well, you can look back and say, well, at those points, value was at its most expensive relative to growth. And so, as I think about PEs relative to long-term averages, we're still seeing large growth PE ratios higher than their 20-year averages after these declines. I'm not super comfortable investing at those, or what are maybe at best average valuations. In contrast, though, there are areas of the market that have been declined in a greater way. And so I think those are areas where there are real opportunities to buy assets that will be likely worth a lot more later at values that are far more attractive. So it would be difficult to completely ignore the government and the Federal Reserve's activity. I don't think that there's a lot of predictive or useful value, but I wouldn't have felt right to not at least take a look at it in reviewing Q1, especially given the Fed's activity. So, but I think it's important as we look at what that is to put it into some context. So the announced CARES Act is about 2.2 trillion. That's almost 11% of GDP. So 2.2 trillion is a ton of money, but the aggregate measure of the U.S. economic activity per year is, almost 10 times that. And then in the top right graph here, we have the federal budget surplus versus deficit. And the blue line shows you what that CARES Act represents relative to the budget. And then these forecasts are both a baseline as well as the JP Morgan forecast. And so, forecasting is a difficult profession, one that I'm glad I'm not in. But they're estimating there's going to be a significant amount of stimulus that's going to be provided next year as well. And then they budget some in through the entire additional decade. And then the graph right below that shows what the net debt to the U.S. is, the net effect of that in terms of the amount of debt relative to GDP. And so, I look at this and say, there are not enough people sounding the concern alarm about the level of U.S. debt. I think that there's a case to be made on both sides of that. The case on the side of supportiveness of the U.S. debt is the rates are incredibly low. I think the 10-year fell below 55 basis points today. And so, I'm also seeing prominent investors, Bill Ackman is one of them, saying, that now is the time to go borrow money and invest it in our infrastructure and our future. And then I would look at it this way, right? So if you take 100% of debt versus GDP and pay, we'll make it simple math, 1% on that, that's the same interest expense of 50% of GDP at a 2% interest rate. So debt's, has the potential to weigh on our growth as it gets to an excessive level. However, the yields continue to fall, which is very fortunate for us financing our way out of these sorts of environments. So that was the federal government, the Federal Reserve Bank, supposedly independent of the government. It took rates to zero very, very quickly in response to the environment. They also reinstated a variety of the programs that they initiated in the financial crisis and have expanded some of them in certain ways. And so both the government's response and the Fed's response were incredibly fast in comparison to the financial crisis. And I think that's an enormous reason why we didn't see as it felt like equity markets were starting to fall off a cliff. That's why we saw the bounce that we did in the short run. So just to it's easy to focus a lot on equities. A lot of my asset management background is actually on the fixed income side. And so I don't want to spend 100% of today only on equities and equity oriented perspective. This graph, the blue line is the key part. So it's the nominal 10-year Treasury yield. The gray line is real yield. So that's the nominal yield minus inflation. And so the simpler concept is just what is the yield for the 10-year. And so we can see as of the end of the quarter, it hit 0.7%, the lowest all-time quarter end point for the 10-year Treasury yield. And what does this mean? It means, well, at least for the what I believe to be the safest fixed income securities, there is almost zero yield. And I look at that as saying, there's lots of ways to look at this, but you're really not getting compensated for 10 years worth of maturity risk in any way today. So fixed income is far more complicated than just treasuries. It's far more complicated than just 1 year of maturity point on the yield curve. And so what this does is looks at yield. And so that first two columns are yield, the first one being the end of the quarter, and then the second column being the end of last year. And so as the Treasury yield, 10-year Treasury yield fell from 1.92% to 0.7%, we saw any types of fixed income, or most types of fixed income, shouldn't say any, most other types of fixed income that had perceived credit risk or the risk of default, we saw those yields go up. And so we saw the 10-year fall 1.22%, and at the same time, the corporate investment grade corporate yields rose on average 0.6%, and which means the spread between the two went from what was a fairly, in my opinion, tight 0.8 to 0.9-ish% to 1.8, or sorry, it increased by 1.8, so more like 2.6 in terms of the difference, 2.7. And so the way that I think about this, I think investors should be ignoring historical returns in fixed income. I think that's and it's easy to look at that in a world where most investors are getting their fixed income through bond and mutual funds or ETFs. Practically, though, I think that's a suboptimal way to do it. Investors should be thinking about, on the fixed income side, am I getting compensated for my two key risk types that I take when I'm investing in fixed income? The first being interest rate risk. And I think the answer to that is no, I'm not getting compensated for sure. I wasn't at the beginning of the year. It's even worse today. But on the credit side, this incredible flight away from risky investments or risk in general, and what I think of as a risk repricing in all markets, including the bond market, has created an environment where the risks in investment grade corporate and that credit risk that's being taken, you're no longer, I think you're no longer in that situation where you're not getting compensated for those risks. And so taking on some of that risk, even though there's definitely going to be investment grade corporate bonds that default, and then there'll be corresponding impairment, as long as you're doing it through a very diverse portfolio of corporates, I think you're getting compensated for those risks today. And then if you look down on that last circle, you see that concept of spread widening even magnified with non-investment grade bonds, where at the beginning of the year, a 5% yield is now almost 10 as of the end of the quarter. And so, there's definitely going to be defaults across that universe. And in those defaults, history has repeatedly shown that those recoveries are far less on a percentage basis versus investment grade. And so I think the same thing applies. At some point, man, a 10% yield starts to look pretty interesting, but that's a different animal. And personally, I think that the value, if I'm taking my risk bucket, I'm allocating that to what is a far more efficient, from a tax perspective, risk in equity markets versus the high yield opportunity. Perhaps situationally, when markets are really panicked in certain areas of credit, there might be opportunities where that's not the case, and picking up some high yield exposure might make sense. But that's getting pretty tactical and timing oriented. I philosophically gravitate away from that. At the same time, I think from a fixed income investor's perspective, this concept of evaluating, am I getting compensated for my risk, has to happen as yields approach zero have approached zero and stay close to zero. So that largely sums up the overview I prepared for Q1. I wanted to share a little sample of what I'm working on right now. I'll be actually putting out a 3-part video series. I think each one will be 2 to 3 minutes, so they're relatively short, on what I believe is critical in dealing with volatility, which is an investment plan, a predetermined structure for what transactions or repositionings could be taken in a portfolio. And I believe that, again, the types of declines that we experienced in March and prospectively might experience over the next few months won't come around very often, and they should be looked at as valuable opportunities to attempt to take advantage of, not things that we should be worried or concerned about. And so just real briefly, this example here illustrates a scenario. So the one on the left, to try to I explain what I think the value of developing a plan for investing into risk, whether it's equities or other things, and the potential benefits of that. So on the left, it's both amounts on both sides are $3 million in orientation. The first on the side on the left, you're starting with $3 million, and you're buying and holding it through the entire decline, and it's structured to say from the top it goes down to 50%, and then it goes back to zero throughout. And the middle column on that shows the percent from last. So if you're down 30% so far, and you from the top, and you go to where you're down 37.5 from the top, that's an 11% decline on your money. And so there's some unique elements from a math perspective. The same thing applies on the way back up. On the opposite effect is once you're down 50%, to get back up to the point where you're down 30 from the top, it takes a 40% increase. And so, when I build a plan, and again, everything that I do is custom per each individual and the various different circumstances that drives their situation. I don't like the randomness associated with what is typically recommended, which is a dollar cost averaging structure during periods of dramatically heightened volatility. I think that by identifying points of decline, we can, and this is, there are pros and cons to every methodology. So having a methodology is the most important element. But as I build a case for doing it maybe differently, as long as an investor is comfortable with the idea that a part of this plan is not becoming invested at all, and then dealing with that, because I don't like the idea of initiating an investment plan like what this is designed, and then being faced with a decision to invest later. If you know you're going to get invested at some point, then I would throw this out the window and get invested, especially after the last couple of days of declines. But if you're in a position where and I think there's, as again, investment grade bond yields go up, there are alternatives. If you're comfortable with that, that risk of not getting invested, this plan has the opportunity to, a plan like this is again an example, it creates the opportunity to minimize the downside experience that a buy and hold investor feels, but then capture significant upside opportunity in just the move back to the prior peak. And so I'll save any additional detail for this for the upcoming content that I'll be sharing. Also plan on doing likely a webinar next Thursday to talk in more detail. So at this point, I will pause my prepared comments and slides and attempt to open this up for questions. I have to admit that